As we approach the autumn budget, the UK is bracing for what could be one of the largest tax restructurings in modern history. Today, we will explore why businesses across the UK are preemptively closing their doors in anticipation of new budget proposals from Rachel Reeves. Additionally, we'll be taking a look at the broader implications of these closures, how they are affecting different sectors, and examining key stories making headlines up and down the country. But before we dive into the details, be sure to hit the like button and subscribe to Untold British News. Help us reach our goal of 1,000 subscribers and stay updated with all the latest developments from the UK. The economic climate in the UK has been under immense pressure over the past few years, but we're now seeing a wave of preemptive closures that is unprecedented. Thousands of solvent British businesses are shutting down, not due to insolvency, but to avoid a potential tax hike targeting entrepreneurs. This sharp rise in closures is largely driven by fears surrounding the upcoming autumn budget, which is expected to introduce significant changes to the tax system, particularly in how capital gains are treated. According to official records published in the Gazette, the number of members' voluntary liquidations, MVLs, has more than doubled compared to the same period last year. This is a striking indicator of the anxiety many business owners are feeling. Over 1,600 companies have filed for voluntary liquidation this October alone, and the number of liquidations is accelerating. Just last week, liquidator appointments increased by an eye-watering 238%, leading to a staggering 51% increase in insolvencies compared to the week before. But what exactly is driving this surge in closures? At the heart of this issue is the concern over the future of business asset disposal relief. This tax break has allowed entrepreneurs to pay a significantly reduced tax rate of 10% on profits from selling or liquidating their companies. Without this relief, they would be subject to the standard capital gains tax rate of 20%, a much higher burden for many business owners, especially those in the higher tax brackets. For many, the fear that this relief could be abolished entirely is prompting them to shut down their companies now, before the new rules take effect. Let's delve a little deeper into business asset disposal relief, also known as entrepreneurs' relief. This relief has been a cornerstone of the UK's tax policy aimed at encouraging entrepreneurship. By allowing business owners to pay a lower rate of tax on their gains when they sell or wind up their business, the relief provides an incentive for individuals to invest their time and resources into building companies. However, it has also been criticized for being overly generous to the wealthiest entrepreneurs and for creating disparities between how different types of income are taxed. Currently, entrepreneurs benefit from a reduced capital gains tax rate of 10% on qualifying gains up to £1 million. Above this threshold, the standard rates of 20% for higher rate taxpayers apply. For small business owners who have spent years building up their companies, this relief can mean the difference between a financially secure retirement and one that is less comfortable. But critics argue that the relief primarily benefits the wealthy and that it costs the Treasury billions in lost revenue each year. As Chancellor Rachel Reeves prepares to announce the new budget, rumors have been circulating that business asset disposal relief could either be scaled back or removed entirely. This has created a sense of urgency among business owners, many of whom are now rushing to liquidate their companies before the changes take effect. Julie Palmer, a partner at the corporate recovery firm Begbie's Traynor, explained that many of the liquidations we're seeing now are driven by fears of losing this relief. Palmer noted, entrepreneurs are acting fast to close their businesses before the rug is pulled out from under them. While the potential removal of business asset disposal relief is causing concern, the broader changes to capital gains tax, CGT, could have even more far-reaching consequences. Currently, CGT is charged at 10% or 20%, depending on the taxpayer's income level. However, there are indications that the rate could be increased significantly in the upcoming budget. Some sources suggest that CGT could rise to as much as 39%, aligning it more closely with income tax rates. For those unfamiliar, capital gains tax is a levy on the profit made from selling an asset that has appreciated in value. This can include anything from shares and property to businesses. In theory, CGT ensures that individuals pay tax on income derived from the appreciation of their investments. However, there has long been debate about whether the current rates of CGT are too low compared to income tax rates. Supporters of a higher CGT rate argue that the current system creates an unfair advantage for those who earn their income from investments rather than from labor. For instance, an individual who earns a high salary from employment will typically pay up to 45% in income tax, whereas someone who generates equivalent income from capital gains might pay only 20%. This disparity has led to calls for the system to be reformed to create a fairer tax structure. On the other hand, opponents of a higher CGT rate warn that increasing the tax could stifle investment and entrepreneurship. They argue that taxing capital gains more heavily could discourage individuals from starting businesses, investing in property, or purchasing shares, all of which are vital for economic growth. The potential for CGT to rise to 39% has sent shockwaves through the business community. Entrepreneurs and investors alike are concerned that such a move could significantly reduce the returns they receive from their investments, leading to lower overall economic activity. The fact that the Chancellor has already ruled out increases to other key taxes, such as income tax or national insurance, means that CGT is one of the few remaining options for raising revenue. The government needs to plug a £4 billion hole in the public finances, and it seems increasingly likely that capital gains will be targeted as a way to achieve this. The prospect of higher taxes on entrepreneurs and investors has significant implications for the broader economy. Small and medium-sized enterprises, SMEs, are often seen as the backbone of the UK economy, and they play a crucial role in driving innovation, creating jobs, and generating wealth. However, the uncertainty surrounding tax policy is already having a chilling effect on business activity. Many SMEs are choosing to close their doors now rather than face an uncertain future where they might be subject to higher taxes. This not only reduces the number of businesses operating in the UK, but also has knock-on effects for employment, innovation, and economic growth. The more businesses that close, the fewer opportunities there are for workers, suppliers, and other stakeholders to benefit from the economic activity they generate. Additionally, the rise in business closures is likely to have a negative impact on the broader investment climate. Investors who were previously willing to back UK businesses may now be more hesitant, particularly if they believe that the tax environment is becoming less favorable. This could lead to a slowdown in investment in key sectors such as technology, manufacturing, and real estate. The potential for a significant hike in capital gains tax also raises concerns about the future of the property market. Property investors, who have benefited from relatively low CGT rates in recent years, may be less inclined to buy and sell properties if they face a higher tax burden on their profits. This could lead to a slowdown in the housing market, which is already facing challenges due to rising interest rates and affordability issues. While capital gains tax is a key focus of the upcoming budget, there is also growing speculation that inheritance tax, IHT, could be on the Chancellor's radar. Often referred to as the most hated tax, IHT is charged at 40% on estates valued over £325,000. Critics argue that this tax amounts to double taxation, as individuals are taxed on their wealth throughout their lives, and then again when they pass it on to their heirs. Despite its unpopularity, IHT remains a significant source of revenue for the government, raising billions of pounds each year. However, there are growing calls for the system to be reformed, particularly when it comes to the exemptions and reliefs that are available. For example, under the current system, wealth held in pensions, business assets, and agricultural land can be passed on to heirs without incurring IHT, leading to accusations that the system disproportionately benefits the wealthy. The Institute for Fiscal Studies, IFS, has proposed a series of reforms to the IHT system, including capping the exemptions available for pensions, business assets, and agricultural land. According to the IFS, such changes could raise an additional £2 billion each year without significantly affecting the majority of taxpayers. However, the government will need to tread carefully when it comes to reforming IHT, as any changes to the system are likely to be deeply unpopular with voters. What you think about it, please share your thoughts in comments below and subscribe for more videos. Take care and goodbye.